Hello viewers. Here's the first rule I apply when I'm doing any stock selection. When I pick up any stocks fundamentally good, I look for whether the stock price is above 200 days moving average or just gone past 200 days moving average and has a upward trend. If it has gone past 200 days moving average, I want to know when it has passed. Was it recently or long back? Primary rule when I pick up any stock, I look for this particular signal. I look at the stock price. Was it recently past 200 days moving average? There is a common notion in the beginners often believe that they should buy stocks when they are cheaper and sell them when they hit the 52-week high. However, it is important to understand what cheaper means here. If a stock has hit a 52-week low, there is a reason for it. I did this mistake and I always lost, not sure why my trade was not doing well and it was not giving me a good return. Sometimes if I'm lucky, then I get a good profit. However, it was not consistent. Buying at 52-week low is a very risky purchase and no guarantee that the stock will bounce back. After every buy and sell, end of the month, I go back and look at all my transactions and understand why I lost the money. Most of the time, I end up closing out without any answers. I am not sure what my mistakes are. As I am too invested in the stock market, I wanted to understand how the experts are doing here. What is their methodology and how are they successful? This is where I came across a few books which I listed them in end of this video, which helped me to understand the mistakes I was doing. And one of them is to avoid buying cheaper stocks. What clicked me to change my trading approach is the moving average. Now, I'm finding stocks which are just coming out of the base and crossed 200 days moving average. This could be either coming off of the 52-week low and crossing 200 days moving average, or just coming off of the 200 days moving average after a long sideway movement. Now I don't try the buy low and sell high model. Instead, look for right signals to invest. If you look at the stock here, the stock which I'm showing up is Microsoft stock, which is considered as one of the top stock in the market, and it has been doing very well in the bear market too. If you look at this, I have an indicator called 200 days moving average laid out here, as it is highlighted in a pink color or red color. And you can see very well that the price was below 200 days moving average and it was trending low. But the moment it hit the 200 days moving average and gone past that one, there was a slight pullback just to test whether the demand is there. Then it came back again, hit the 200 days moving average, and then you can see the price trend from then on. And that's the point I consider that as a buy signal. This is my primary rule for any investment, any stock investment. Whenever I pick up a stock for selection, I always look for where is the price, whether it has gone past 200 days moving average or it is below 200 days moving average. Most of the time, especially for some of these good stocks, I tend to be longer in the sense I buy and I don't sell them immediately. I keep them for longer. That way the price appreciates. And you can see Microsoft is a very good stock and I did found a buy signal here, invested some money, and you can see the trend from then on. You can also ask me why we should not invest in a stock where the stock price is below 200 days moving average. There is a reason for a stock to be below 200 days moving average. It could be the economy, or it could be the company is not performing to the current expectation. We have another strategy called shorts or selling short, which could help you to invest on these stocks. However, for this discussion, we'll be focusing only on buying or staying long. Let's look at another example. Here's another company called Steelcase, and you can see that it has just gone past, in July month, it has just gone past 200 days moving average. There was a slight pullback and then again came back above 200 days moving average. From that point onwards, and you can see the trend going up. And this is a classic example. You can always rely on 200 days moving average. Okay. This particular presentation doesn't tell you the projection. Instead, it will tell you the buy signals. It will teach you the buy signals. And you can see here, it has just gone past 200 days moving average. And then after that, the trend is really good. And you can see the volume too. When you are looking at price movement, also consider looking at the volume. Well, we can discuss a little bit more deeper about the volume a little bit later in the video. But for our discussion, we'll just primarily focus on the moving average. Viewers also posted another question. They would like to know whether they can use shorter length moving average. Example, 20 days, 50 days, or 150 days moving average. Yes, it all depends on what type of stock trader you are. Day traders and swing traders tend to use shorter length moving averages. They primarily use 20 days or even lesser than that. 20 days and 50 days are very common, where they want to take quick profits from the market. Mid and long-term traders look for 150 days and 200 days moving average, as this confirms a longer room for price movement or for price growth. Knowing this simple rule changed my approach and took away some of these sleepless nights, anxious about my investment. Now, as far as the price is higher than 200 days moving average, I know I am in safe hands and I follow through this every day. The moment the price moves below 200 days moving average, that's when I take action. I will analyze the market just to see whether this stock has a pullback versus was there any sell signals. Let's talk about the sell signals later in this video.